Over the last decade, dividend ETFs have exploded from under $20 billion in assets to more than $350 billion today. And leading that charge? The legendary SCHD, the Schwab U.S. Dividend Equity ETF. It's simple, reliable, and has paid investors consistent income year after year. For many people, SCHD became the gold standard, the one ETF to hold forever. But here's the reality. Most investors haven't noticed yet. While SCHD is still a great fund, the market is shifting, and a few lesser-known dividend ETFs are quietly crushing it in both total return and dividend growth. Over the past 5 years, SCHD returned around 79%, impressive, no doubt. The fifth ETF in this video has delivered 94%. Another grew its payouts by 9% annually, and the 8 pays monthly income that's beating SCHD's quarterly cash flow by a mile. By 2030, these funds could completely reshape dividend investing, and if you're still relying on SCHD alone, you might be leaving serious money on the table. In this video, I'll compare SCHD to 10 dividend powerhouses that combine strong income, consistent growth, and long-term compounding, and by the end, I'll show you how a smart mix of these ETFs could potentially beat SCHD by 2030. Hey, I'm Noah, and if you're working toward early retirement or just want your money to start working harder for you, you're in the right place. Go ahead and subscribe, tap the bell, and let's get started. Oh, and just a quick reminder, this video is for educational purposes only and not financial advice. Always do your own research before investing. Let's start with what SCHD does right. It's built on high-quality U.S. companies with a proven history of paying dividends, names like PepsiCo, Amgen, and Broadcom. It yields around 3.8%, charges only 0.6%, and has earned its reputation as one of the most efficient dividend ETFs ever. But here's the issue. SCHD has struggled recently. Over the past year, while the broader market gained nearly 15%, SCHD's total return went negative about -2%. Why? Sector concentration. Roughly 40% of the fund sits in energy and consumer defensive stocks areas hit hardest as growth rebounded in 2024 to 2025. So while SCHD still pays strong income, it's lagging in total performance, and that's where the next generation of dividend ETFs is stepping up. Now, the first challenger challenging SCHD is VIG, Vanguard Dividend Appreciation ETF. At first glance, VIG doesn't scream income. Its yield sits at just 1.6%, far lower than SCHD's 3.8%. But that's where most investors stop, and that's the mistake, because what VIG lacks in yield, it makes up for in growth and consistency. It focuses on companies that have increased their dividends for at least 10 straight years, real dividend growth champions. Over the last 5 years, VIG has returned over 86% total, compared to about 79% for SCHD. Its 10-year total return? More than 250%, driven by earnings expansion from companies like Microsoft, Apple, and Broadcom, all dividend growers that also deliver capital appreciation. And here's the magic. VIG's 5-year dividend growth rate is 9.6% per year. That means your yield on cost doubles roughly every 7 to 8 years. So while SCHD focuses on today's yield, VIG builds tomorrow's income. It's the difference between living off interest and building wealth that pays you more every year. Now, let's talk about DIVO Amplify Enhanced Dividend Income ETF. This one's different, and it might be the most practical for retirees and cash flow investors. Unlike most dividend ETFs that pay quarterly, DIVO pays monthly, and that changes everything when you're living off income. It yields around 4.5%, higher than SCHD, and combines dividend stocks with a covered call strategy, meaning it sells options on its holdings to collect extra income. That added income helps buffer volatility. Over the last 5 years, DIVO has returned about 90% total, outperforming SCHD while paying higher income every single month. Its holdings? Think quality growth. Apple, Microsoft, Visa, and United Health. These are not slow value names. They're companies that grow while still generating yield. Yes, DIVO's expense ratio is higher at 0.55%. But you're paying for active management, monthly cash flow, and downside protection. It's the ETF version of getting a paycheck every month, something long-term investors love. Next up, DGRO, the iShares Core Dividend Growth ETF. DGRO is what I'd call the Goldilocks ETF. Not too aggressive, not too defensive, just right. It yields around 2%, but with higher growth potential than SCHD and a more balanced sector mix. Its 5-year total return is 94%, outpacing SCHD and even VIG slightly. Why? DGRO filters for companies with consistent earnings growth, strong balance sheets, and sustainable payout ratios, meaning the dividends are healthy, not forced. Top holdings include Apple, JP Morgan, and ExxonMobil, giving you exposure across tech, financials, and energy. This balance allows DGRO to handle both bull and bear markets, smoothly growth when markets surge, income stability when they don't. Expense ratio? Just 0.08% dirt cheap for this level of quality, and like VIG, DGRO's dividend growth rate has averaged nearly 10% annually, which compounds powerfully when you reinvest over time. For many investors, DGRO is becoming the core growth and income ETF SCHD used to be. When markets drop, those premiums act like a cushion. Next up is the Vanguard High Dividend Yield ETF, ticker VYM. This ETF focuses on large-cap U.S. companies with strong, established dividend histories. It's less flashy than SCHD, but that's exactly why it works. VYM's current yield is around 3.2%, and it's built with over 400 holdings, making it one of the most diversified income ETFs in the market. Top positions include Johnson & Johnson, ExxonMobil, and JP Morgan Chase, all dividend giants with decades of payout, consistency. While SCHD has struggled recently due to its heavy weighting in consumer defensive and energy sectors, VYM's broader diversification helped it hold up better in 2024 to 2025. Its total return and risk-adjusted performance have quietly outperformed SCHD during this period. With an ultra-low expense ratio of 0.06%, VYM offers rock-solid reliability for investors who want long-term dividend growth without over-concentration risk. Think of VYM as the steady marathon runner. It's not about quick bursts, it's about endurance and compounding wealth over time. Next, JEPQ Premium. JP Morgan NASDAQ Equity Premium Income ETF. The most popular income ETFs right now, JEPQ from JP Morgan, it's a hybrid between growth and income, combining NASDAQ 100 exposure with a covered call strategy that generates steady monthly cash flow. The yield sits around 10 to 11%, paid monthly, which is massive compared to SCHD's 3 to 4%. But what's even more impressive is that JEPQ has managed to maintain NAV stability while paying that much. That's rare in the world of high-income ETFs. The holdings read like a who's who of tech leaders: Microsoft, Apple, Nvidia, and Amazon, all of which have delivered explosive growth over the past decade. And because the fund collects option premiums, it can profit even when the market moves sideways. In 2024, JEPQ's total return actually outpaced SCHD while paying nearly triple the income. For investors who want tech growth plus real monthly income, JEPQ is one of the most innovative solutions out there. It's like owning NASDAQ power with a paycheck attached. Next is JEPQ's sibling, JEPI, the JP Morgan Equity Premium Income ETF, and one of the most admired funds in the dividend community. JEPI takes a similar covered call approach, but focuses on the S&P 500, offering a more diversified and slightly less volatile portfolio. The yield typically hovers around 8 to 9%, and yes, it pays monthly, which makes it perfect for retirees or anyone looking for a consistent income stream. What separates JEPI from traditional dividend ETFs like SCHD is its ability to generate income regardless of market direction. When volatility rises, option premiums increase, boosting yield. Over the past 3 years, JEPI's total return has beaten SCHD in multiple periods while maintaining a smoother ride. Its top holdings include companies like Microsoft, Amazon, and MasterCard. But the real magic lies in its structure. It's actively managed, yet costs only 0.35%. In short, JEPI is like the balanced paycheck ETF, steady, resilient, and designed for investors who want cash flow without sacrificing long-term performance. NOBL, ProShares S&P 500 Dividend Aristocrats ETF. If you believe in the power of consistency, then NOBL, ProShares S&P 500 Dividend Aristocrats ETF deserves a place on your radar. This ETF tracks the S&P 500 Dividend Aristocrats Index, which only includes companies that have raised their dividends for at least 25 consecutive years. That's right, through recessions, inflation, and market crashes, these companies kept increasing their payouts. We're talking about legendary names like Coca-Cola, Procter & Gamble, and McDonald's, firms with durable business models and bulletproof balance sheets. NOBL's yield sits around 2%. But don't let that low number fool you. Its dividend growth rate and price appreciation are what make it powerful. It's designed for stability and long-term compounding, and over the last decade, its total return has rivaled SCHDs with less volatility. For investors planning for retirement or wealth preservation, NOBL brings peace of mind. You're not just buying dividends, you're buying 25 plus years of reliability and discipline. It's the definition of quality over quantity. Another strong performer in the dividend space is SDY, which tracks companies with at least 20 consecutive years of dividend increases. This ETF sits right between NOBL's stability and SCHD's yield, offering the best of both worlds. The yield typically lands around 3.4%, and its sector exposure is broad, from financials and industrials to consumer staples and utilities. This diversification has helped SDY deliver steady total returns over time, often keeping pace with or even outperforming SCHD in certain cycles. What makes SDY particularly attractive is its resilience during market downturns. When growth-heavy funds dip, SDY's defensive tilt helps cushion the fall while continuing to generate income. It's the type of ETF you can confidently hold for the next decade, knowing your dividends are likely to grow and your capital remains protected. Think of SDY as the all-weather income ETF. Steady growth, healthy yield, and a time-tested track record of dividend dependability. Next up is HDV, the iShares Core High Dividend ETF, a fund built around financially strong, high-yield companies screened for sustainability. Its yield hovers around 4%, making it slightly higher than SCHD. But what really sets HDV apart is its quality screen. It prioritizes companies with durable earnings and reliable cash flows. Top holdings include Chevron, ExxonMobil, and AbbVie, each with a strong dividend commitment. HDV tends to perform exceptionally well during volatile markets, providing a defensive income base when other funds wobble. And with a 10-year track record of competitive total returns and consistent payouts, it's quietly built a reputation as a core holding for conservative dividend investors. With an expense ratio of just 0.08%, it's cost-efficient and income-focused, perfect for investors who want stability with a touch of high yield. In short, HDV is your sleep well at night ETF, reliable, defensive, and built to protect while still paying you. Let's wrap up with one of the most talked about income ETFs on the market, QYLD, the Global X NASDAQ 100 Covered Call ETF. This fund is designed for investors who want immediate, high monthly income, not long-term speculation. It tracks the NASDAQ 100 home to companies like Apple, Microsoft, and Nvidia, but adds a powerful twist. It sells covered calls every month on the index, generating massive option premiums that are then distributed to investors as income. The result? A yield that can reach 10-12% annually, paid monthly, one of the highest among major ETFs. Even when the market trades sideways, QYLD keeps earning because volatility fuels its income engine. Now, this ETF isn't built for explosive capital growth like VIG or DGRO, it's built for cash flow stability. Over the years, it's helped investors smooth out their returns by turning tech market volatility into regular monthly payments. And while SCHD investors wait 3 months for each dividend, QYLD holders get paid every 30 days. That frequency makes a huge difference for retirees or anyone building a passive income stream. So if you want an ETF that transforms market movement into consistent, high-yield cash flow, QYLD is a must-watch. It's the monthly income powerhouse that keeps paying even when others pause. At the end of the day, SCHD is still one of the best dividend ETFs ever created. It's reliable, consistent, and built for income. But the market is changing. The next decade belongs to funds that can deliver both growth and income, not just yield alone. By combining ETFs like VIG, DGRO, DIVO, JEPI, and JEPQ, investors can build a portfolio that pays monthly, grows yearly, and compounds for decades. Thanks for watching. If you found this breakdown helpful, don't forget to like, subscribe, and share so more investors can learn how to make their money work smarter.